Cathie Wood launched her own investing firm, ARK Invest, in 2014, and it now oversees a stunning $60 billion. Her ARKK invention ETFs soared 151% in 2020, while the S&P 500 was up 17% and the Nasdaq was up 43%. Her flagship fund has returned 225% since inception, compared to 146% for the S&P 500 and 212% for the Nasdaq. Her fund, however, has recently encountered difficulties. Cathie's fund has returned 19% over the last 2 years, compared to 26% and 29% for the S&P 500 and Nasdaq respectively. Has she lost her touch? Alternatively, does she notice something that orthodox portfolio managers have overlooked? Cathie recently discussed current economic conditions in the context of the Russia-Ukraine conflict, as well as her economic perspective and investing thesis. We'll talk about her comments on some of her recent trades in this video. But before we begin, make sure to keep yourself informed and engaged by subscribing to the channel, clicking the notification bell, and turning on all notifications so you won't miss our latest uploads. We must first explore her investing thesis, which will explain her recent performance before we can discuss her economic beliefs. Cathie Wood's flagship innovation fund, as she puts it, invests in disruptive enterprises. These businesses have technology breakthroughs that have the potential to revolutionize the way the world works. Consider it like picking stocks for the next Google, Amazon, or Meta. Coinbase, Snowflake, and CrowdStrike are current examples of this. These stocks, on the other hand, can trade at inflated prices. The price-to-earnings multiple, or PDE ratio, of innovative stocks is high. The price-to-earnings ratio is a common comparison indicator as the amount of years it takes for a stock to return its full market capitalization. For example, if a stock has a PDE ratio of 30 and earnings remain constant, it'll take the company 30 years to repay back the money invested. If you put $100 into a company with a PDE ratio of 5, the company will return it to you in 5 years, assuming all other variables remain constant. The PDE ratios of firms in the same industry are frequently compared by ARK's analysts. You wouldn't compare the PDE of a utility firm to that of a retailing software company, for example. This is due to the fact that each business has unique tailwinds, financial structures, and consumer behaviors. In 2005, Google was an innovator and traded at a premium valuation. It traded at 50 times price-to-earnings ratio, while the Nasdaq traded at 25 times earnings. Based on Google's PDE ratio in 2005, you would think that the Nasdaq would have been the better value, but that wasn't the case. In fact, it took several years for Google's stock price to trade at roughly the same PDE as the mark. Cathie Wood examines the price of their earnings to growth rate, also known as the PEG ratio. To grasp this, we must contrast two equities. If stock A is predicted to increase earnings at 10% per year and stock B is expected to grow earnings at 25% per year, both trade at looks to be the same value, but they aren't. If earnings growth rates are different, make an adjustment to the PDE ratio. The PEG ratio is calculated by dividing the PDE multiple by the growth rate. The 5-year projected annual growth rate is applied in this example. The price to earnings to growth rate, or PEG, for business A is 2.5 times, whereas company B's is 0.5 times. Cathie Wood examines this as one of her objects. She is considering the PEG ratio rather than the present earning multiples. Returning to our Google example 5 years from now, although it may appear that investors would have been better off holding the Nasdaq in 2005, this could not be further from the truth. Google has returned 2,532% since April 2005, while the Nasdaq has returned 548%. In fact, Google nearly doubled the Nasdaq's annual return of 13%. This considers the most recent COVID crisis and the Ukrainian-Russian conflict. Investors should be on the lookout for the next Google, and Cathie Wood is doing just that. Her stocks will have a high PDE ratio because she concentrates on breakthrough technology. To determine value, her experts make comparisons using the PEG ratio. In relation to stock prices, high PDE ratios and growth rates may be erratic, but volatility isn't always bad because it can also work on the positive. Here's a graph displaying Cathie's top 5 holdings: Tesla, Teladoc, Roku, Zoom, and Exact Science, as well as the Nasdaq, with their respective PEG ratios. The ratios are normalized against the Nasdaq in this chart. which means they are relative to the Nasdaq PEG ratio at 0. Only Teladoc and Tesla have regularly moved substantially above the Nasdaq's PEG ratio, despite the fact that the Nasdaq's PEG ratio is currently lower than 4 of Cathie's top 5 holdings. Here are Cathie's top 15 ARKK holdings. The important thing to note here is that only 4 equities stand out as trading substantially over the Nasdaq's PEG ratio. The rest are still high, but not as high as Nasdaq's PEG rate. Keep in mind that the Nasdaq contains equities from industries other than technology, such as Starbucks. While not all of Cathie Wood's predictions will be winners, some could be the next Google or Tesla in the next 5 years. This volatility explains why Cathie Wood's ARKK is so volatile. This volatility explains why Cathie Wood's ARK ETF has underperformed the Nasdaq and S&P 500 over the previous 2 years. Cathie Wood recently discussed the reasons for these stocks to decline. Is this, however, a buying opportunity? To comprehend this, we must go deeply into the economy. In Cathie Wood's situation, the Russian-Ukrainian war's high inflation has drove down ARK's valuations during the last 2 years. Cathie attributes the mismatch between long-term investing and short-term investing on algorithmic traders. Algo trading is always focused on the short term and is heavily dependent on the path of the US economy and market developments, such as when rates are predicted to rise. Algorithmic traders frequently invest in banks and utility firms that gain from higher interest rates. Due to developments in the economy, algo traders are also selling high multiple stocks. Algo traders were selling equities based on cash burn rates and cash cushion levels, according to Cathie. These indicators are proxies for how much cash a corporation has on hand and how quickly it spends it. Keep in mind that as interest rates rise, borrowing money becomes more expensive. Rates have changed dramatically in the last 2 years. Interest rates were nearly 3% in 2018, but now range between 0.25 and 0.5%. All of these macroeconomic issues have an impact on ARK's investments. This next graph compares a 2-year treasury yield to the S&P 500 and Nasdaq. Notice how rates have fallen in the previous 2 years while the economy has struggled. The Federal Reserve's measures aided the economy's recovery into a V-shaped pattern, and the stock market recovered. The PDE ratio and rates tell the whole story. We got this chart after correcting the preceding chart for PDE ratios. The 2000 Nasdaq bubble is readily visible here, as is the inflated valuation since 2020. The market is expected to pull back as interest rates rise. Cathie Wood looks to be correct at this time. Algo traders and short-term investors have punished creative stocks that trade at high PDE multiples as a result of increasing rates and the conflict. The greater the fall, the higher the multiple. Examine the graph of ARKK case pricing performance versus interest rates. What about the PEG ratio though? Cathie Wood equities may be undervalued on a 5-year PEG, but investors are more concerned with the short term. Although investors should exercise patience, many are worried about the economy. Cathie would dissect the economy into 3 parts: monetary policy, fiscal policy, and economic activity. The Federal Reserve manages interest rates and the money supply in the economy through monetary policy. The mission of the Federal Reserve is to keep people employed and interest rates constant at roughly 2 to 3%. This implies that inflation should be between 2 and 3%. Today's investors are concerned about the prospect of inflation. Consider the price of commodities during the past year. These are frightening price hikes that serve as a direct tax on consumers. Gas prices have risen to $5 and even $6 per gallon in certain areas, and oil has climbed to $110 per barrel. Housing expenses have been rising in tandem with lumber prices. Cathie feels inflation isn't here to stay. This longer-term CPI chart shows how inflation has been tamed since the 1990s, compared to the early 1900s to the 1940s. Today, inflation is at 7.5%, the highest level since the early 1980s. Although it is expected that inflation will reach 10%, one must wonder whether this will actually happen. Cathie is one of those people because inflation is influenced by a number of things, one of which is the frequency with which money is exchanged. M2 is a measure of money in the economy and is also known as the velocity of money. The velocity of money was 1.1 times in the fourth quarter of 2021. It has been decreasing significantly since the high, contributing to higher inflation rates during those periods. In the 1960s, the velocity of money increased by 21% as many people purchased goods and services right away. They were afraid of prices rising, so they bought goods as quickly as they could. This became a self-fulfilling prophecy as the high velocity meant that prices just kept rising. The core CPI, which excludes energy and food prices, is compared to the S&P 500 and M2 velocity in this graph. Money velocity has decreased dramatically from the third quarter of 1997 to 2021. The market began to take off as M2 velocity fell, and inflation became less of a concern. Cathie believes that this will keep long-term inflation under control and prevent the Fed from hiking rates too soon. She also noted that consumer sentiment or customer expectations to buy new things, such as cars, mattresses, and televisions, has decreased dramatically. Consumer sentiment has risen since the Great Financial Crisis of 2008, but has recently fallen. The recent downturn may help to limit salaries and prices from reaching all-time highs. The CPI without food and energy is depicted here, but scaled to 10 times its original size. Consumer sentiment has a tendency to influence inflation figures, and current attitudes suggest that recent inflation may be temporary. Cathie also mentioned increased energy use as a percentage of GDP as another levy on consumers to keep inflation and customer goods under control. Another explanation for the short-term nature of inflation is government spending. The present administration has prioritized cutting government spending. The government spent money in 2008 to keep the banking system solvent. In 2020, a more extreme version of this occurred. However, it is now beginning to cool off. Fiscal spending grew 18% year over year in the fourth quarter of 2021. Fiscal spending will almost definitely continue to fall year over year, as it did in the aftermath of the 2008 recession. The increase in 2020 came from $7 trillion in increased expenditure that the Fed is attempting to eliminate from the economy. That simply resisting government expenditure will have to keep inflation at bay. Cathie also talked about unemployment statistics, wage growth, and labor force participation. Labor force participation has lately increased, yet non-farm payrolls have decreased, as shown in this graph. More people are employed, but at a lesser wage. Non-farm payrolls continued to rise throughout the 1960s and 70s until Fed Chairman Paul Volcker began raising interest rates to limit inflation. At the same time, when jobs became scarce, labor participation fell. This is the polar opposite of what is currently taking place. Jobs are plentiful and incomes are decreasing. Cathie also keeps an eye on retailer inventory levels to keep an eye on inflation. Inventory has recently begun to return to businesses. Goldman Sachs recently dropped his supply chain stress index from 10 to 9 and then to 7. The percent change in inventories from the previous quarter is seen in this graph. If consumer demand was rising, inventories will not be rising as quickly as they are now. So, what does this mean for interest rates? If Cathie is correct, the market is incorrect about inflation, then the Federal Reserve will not raise interest rates as quickly as projected. Cathie added that she feels the Fed would only perform one more rate hike after the last one. The rest of the market, according to Bloomberg, expects several rate hikes, with rates rising to 1.78% from present levels. If Cathie is correct about rates and inflation, her stocks will likely rebound strongly as long as rates remain low, inflation is contained, and multiples begin to expand again. The reduction from the second half of 2021 to the first months of 2022 was 50% in just a few months. Long-term investors are seeking for long-term gains rather than short-term volatility. Private equity funding rounds also support Cathie's viewpoint. While innovation stocks have fallen, private early innovation investors have witnessed prices rise in the last 2 years, particularly in the last few months. Between November 2021 and February 2022, the valuations of 379 CBC and higher rounds of capital raising grew from 2.2x to 2.8x. Series C is an earlier type of private market capital offering. Although there is some lag in this data, private equity valuations remain robust in December 2021 and January 2022, while equities markets dropped. So, how does this affect ARK and Cathie Wood? Because of the characteristics we discussed earlier, her recent performance has been at the mercy of short-term traders. Challenging market conditions and a war inflation is unlikely to spiral out of control. The Fed will most likely not have to hike rates as quickly, which will help equities. If you trust Cathie's economic forecast, you should consider making a long-term investment. Selectus, Palantir, Aqua Bounty, Trimble, Evogene, Open Door Landing Club, Lockheed Martin, Intuitive Surgical, Twitter, Etsy, and Insight are among Cathie's recent ARK transactions. Burning Rock, 908 Devices, Joby Aviation, Velo 3D, Adaptive Biotech, Codexis, One Life Healthcare, Stratasys, Two Simple Holdings, Square, DraftKings, and Shopify are also among her recent purchases. Let me know what you think of ARK Invest in the comment section below. Do you believe this is a good time to buy, or is it just a bull trap? Thank you so much for watching. If you liked this video, please remember to like, share, and subscribe. See you guys in the next one, and remember, keep living life bullish.